Hi, good evening, everybody. This is Sahil Kapoor. I head the products and market strategy at DSP. Today, we're going to talk about something very, very special, and it's about disruptive innovation, how to invest in disruptive innovation. I think it's a topic which is very, very critical, very important today. Innovation is evolving, as you know, it has critical mass. It's rolling on at a very fast pace, changing lives, changing business landscape across the world. And I think it has one of the most critical aspects of investing today. Um, Something very similar to, let's say, what we had like emerging markets in 1980s. It's a secular theme. Uh, I guess innovation investing has always been there for maybe more than a century. It changes shapes, it changes technologies, but it's been a secular trend forever. And I think this is probably the time of our lives where we have to look at this theme very, very crucially, very, very, with a lot of focus. Today, there could not be any other better person to talk about disruptive innovation. And my guest today, I'm joined by Renato Leggi from ARK Invest. Uh, I think it's one of the most important topics today, and we've got one of the most exciting speaker to talk about it. Renato Ren joined ARK in October 2018, and he's ARK's client portfolio manager, and he works directly with ARK's investment team to communicate their knowledge and investment grade ideas in detail to all the investment managers. Prior to ARK, Ren was Vice President and Director of Investment Research and Due Diligence at Capital One Wealth and Asset Management. He's also worked in the past with a lot of important organizations in the world: Morgan Stanley, Nomura Holdings, Legg Mason. Uh, Ren is a CFA and CAIA charter holder, and he earned his Bachelor of Business Administration in Accounting and Master of Science in Finance from Loyola University, Maryland. Ren, a warm welcome to you. Thank you for finding time for us today. Uh, Welcome to this interaction today. And if you could just brief us about ARK Invest, about yourself. Thank you.
Sure. Thank you for having me. It's good to see you. And this is a very exciting topic, one that I'm very passionate about. And these disruptive innovation technologies are going to change our lives for the better. And right now, it's presenting a very attractive investment opportunity. So very excited to kind of dive deeper into these technologies and how we look at innovation. So for those of you less familiar with ARK Invest, we've been a firm that was founded back in 2014 by Cathie Wood. She is our CIO and CEO of the firm, and she really founded the firm for two main reasons. One, to focus solely on disruptive innovation and investing in it. We think it's one of the most inefficiently parts of the market right now, and also to create new dimensions in research. So all the topics that I'm going to touch on today, all of our research is out there for you all to consume and read and digest and follow along with us as we invest in these technologies. So we keep it completely open source. And I think that's what's made our ability to keep track of these technologies and uncover the companies best positioned to be the winners in each of these areas by keeping this open mindset, which is not typical in a traditional Wall Street firm. So we were based in New York. We've recently relocated down to St. Petersburg, Florida, where the team is based. Where we have about 45 employees, and we're now managing just shy of 60 billion USD across 14 strategies, all centered around disruptive innovation.
Absolutely. Ren, thanks for that introduction. Very, very useful. And I know your favorite innovator is Alan Turing, and one of his quote is, we can only see a short distance ahead, but we can see plenty that there needs to be done. But I understand that your investment philosophy and the way that you work, you probably see more than a short distance ahead. You look at, trends which are unfolding over decades and, try and benefit from them. I want to understand why disruption, and first of all, what is disruption? What is disruptive innovation? How do you define it? And why now? What do you think is the reason why this should be looked at right now?
No, that's an excellent question, right? And we are in a many people say, the world is changing at a rapid pace, and certainly the pandemic has caused us to make some dramatic changes in our lives. but we are in a very unique time period in technological history, the likes of which that we have not experienced in over 100 years. And that's because we are seeing 5 innovation platforms. So the way we define these innovation platforms, we have a set criteria that determine whether these 5 innovation platforms are investable now. And I'll go through that in a moment. But before I do, just taking a step back and looking at on this slide here, you see all the innovations, and this is just a brief summary of the innovation platforms that have existed over the last, call it, 250 years. But if you go back to the late 1800s, we saw or experienced 3 innovation platforms evolving at the same time. You had the telephone, the automobile, and electricity all evolving. And that led to about a 50-year economic boom growth cycle that lasted from the late 1880s into the roaring 1920s. And since then, as you can see on this chart, again, not all the innovation platforms are here, but we haven't experienced more than 2 innovation platforms evolving at the same time. The last big one that had certainly a very dramatic impact on our lives has been the internet. But that was just the only innovation platform really evolving at that time. Now with the 5, so artificial intelligence, which is really, we're focused on deep learning. This is really taking the human element out of the equation when it comes to developing software. So we're collecting massive amounts of data. We've in just the last 3-4 years, we've collected the most data we've ever collected in the world's history. So now it's time to analyze and make use of that data, and that's exactly what deep learning does. Energy storage is the second platform, and that's all about kind of this shift away from gas-powered cars to electric vehicles, and that's just one form, but that is probably going to be the most impactful. And this will have this will help drive the cost of transportation downward. And then on top of that, you have autonomous driving, which will further lower the cost, the per mile cost to get places. Robotics is the third, and that's really focused around adaptive robotics or collaborative robots, not the robots that we see in the traditional auto manufacturing space, but robots that we're seeing that are working alongside humans, like in Amazon's warehouses, right? Taking items, putting them in boxes. And what's interesting is we're hitting, last year was a critical crossing point where, these robots are hitting human capability, and people think that they will just kind of plateau and stay the same, just be as good as humans. But in fact, we're seeing that they could exceed capabilities of human. And I know that can seem scary to many people, right? In the fact that, there could be loss of jobs, but yes, this is displacing workers, but it's also creating new industries that are going to create even more jobs. And the net benefit will be very positive in terms of how automation through these robotic systems will actually create, trillions of dollars worth of GDP growth over globally over the next 10 years. So that's the third. Genome sequencing is really, one that has helped us get through this pandemic, right? Allowing us to understand the virus. We were able to sequence it in less than 3 days. Shortly thereafter, about 42 days, we were able to develop a vaccine using this underlying technology. And now those vaccines have been rolled out. We're still getting through the variants, but we would be a lot further along. A lot farther behind if this, say, were to happen in the early 2000s, just similar to what we've seen with kind of SARS and other coronaviruses in the past, where it takes a long time to kind of adapt to this. So genome sequencing is a very critical technology right now, and it's gained a lot of traction. And we think probably one of the most misunderstood spaces, the general genomic biotech space, is just one that many people, especially on Wall Street, have not been able to really grasp because there's so much innovation happening. And then finally, blockchain technology. And this is, we've been very focused on Bitcoin as a store of value. So essentially kind of replacing gold in a way, or becoming kind of a neo gold as a inflation protection. I know we'll talk about that a little later. but also now with the metaverse, and we'll talk a little more about that as well, but how cryptocurrency could play a role in that aspect through non-fungible tokens, and those are being built on top of Ethereum. So very exciting areas in blockchain, and we think that is going to be one of the more impactful technologies to the financial services industry, where there's a lot of friction, and blockchain is about removing that friction. So I'll just wrap up on one last point here, right? These 5 innovation platforms, just to give you a sense of how big these opportunities could be. At the end of 2019, we estimated that the total market cap or total business value associated with these 5 platforms was right around $7 trillion. Post-pandemic, so 1 year later, we estimated that because of the growth in these technologies and really the acceleration and adoption for these technologies, we estimated that value basically doubled to $14 trillion. And our prior forecast pre-pandemic was that these 5 platforms could grow to $75 trillion by 2030. And because of breakthroughs in artificial intelligence and blockchain and even electric vehicles, we're seeing that number could actually be in excess of $200 trillion. So a massive investment opportunity over the next 10 years and within our lifetimes. And when you look at the value today, now back below $10 trillion, it's setting up investors for a very attractive long-term investment. If we're right about these platforms and they scale to that size, not only will they create a tremendous amount of value, but they're also going to disrupt many of the existing companies and industries that we know today. And so it's very important that investors are bracing their portfolios for innovation and have exposure to these forward-looking, not only technologies, but also the underlying companies that are leading the path for these innovations. This has become more important than ever to really be focusing on these 5 platforms.
No, Ren, I think it's very, very interesting for me. I'm a graduate in science, so these things interest me a lot. I've been an ardent reader of, from the beginning of genome sequencing and how .NET and Charpentier changed the world last year. One question, the numbers that you just said, just to put them in context, you're saying that in 2020, the whole opportunity size, so to speak, is closer to about $15 trillion, right? Which is almost as big as 18 to 20% of world GDP today. And probably, 75 trillion by 2030, you're going to add another, world GDP. Right now, I think it's closer to 85 trillion. So roughly you're going to add another GDP to the world only using these technologies, right? So, Ren, one question before we move on to some of the deeper aspects of these technologies. Why do you think these technologies are coming together right now? What have we done to see so many general purpose technologies coming together at this time in these 20 years? Any specific things which have happened in the last 20, 30 years which has allowed this to happen?
Yes, absolutely. And that's a very important question to ask, right? And on the next slide here, there's really what we've done is we've studied these innovation platforms over time, right? And this is we subscribe to the theory of general purpose technology platforms. So this is heavily researched in academia, nothing that we're making up. But what we did when studying these innovation platforms over time, we noticed that there were 3 criteria that helped us define when and determine when these technology platforms were ready for investment. And Kathy says they're ready for prime time investing. And because one of the biggest mistakes that we've seen investors make when it comes to investing in technologies and innovation is that they invest too early in these technologies. And that could be detrimental. I mean, you could kind of sit there with an investment that may take, 5-10 years to actually play out. And you're just investing way too early. So it's important to identify when we are going to hit that tipping point in that innovation platforms that will make it a viable investment over the next 5 to 10 years, which is, within our time horizon of 5 years. That's very important, and hit that. You don't have to be exact on your inflection point, but you want to make sure this technology isn't like, for instance, a good example would be quantum computing, right? One that, yes, will be very disruptive, but we're probably at least 10 years out before we can actually see that as an investable technology. So we have plenty of time. We're keeping an eye on it, but we're just not investing in it quite yet. So these 3 criteria are, first, that these technology platforms are experiencing a very steep cost decline associated with them. So an example, I'll use electric vehicles. We've seen that the cost of EVs have dropped dramatically over the years. And we use a tool called Wright's Law, which helps us forecast those future cost declines. And we've studied gas-powered vehicles and those cost declines. But that's over 100 years, right? And the EVs are very new. And so what we're seeing is the increased production is leading to learning curve gains, which is driving the cost down for lithium-ion battery, the underlying technology. And we think the cost of EVs will actually drop below that of gas-powered very, very soon. We're a year, maybe 2 years away from that happening. And that's going to shift adoption by consumers to buy. And we've seen that already in 2021. 4.3 million EVs were sold. We think that number will be 40 million by 2026 because of this, because of the technology hitting that tipping point. The second criteria is that these technologies are impacting multiple industries and sectors. So the underlying technology there, lithium-ion battery, is not only being used in just cars, we're using it in aerial drones, which we think will have benefits in parcel delivery, human transport, transporting medical devices, organs. We're also seeing it in micro mobility with scooters and other electric-based technologies. So this helps kind of further expand the adoption of the underlying technologies because it's being applied to multiple industries and sectors. And then finally, these technologies really serve as platforms or essentially launching pads for other technologies to be built on top of them. This gives us a front row seat to new technologies being built on these platform technologies. And that's where we get a lot more ideas and see how these technologies grow over time. And many of them could eventually become kind of platform technologies as well. So that's how we really determine. And I think the last point I'll make, and one of the other mistakes that we've seen investors make, is that they overpay for a lot of these technologies. And so think of this process, this 3 criteria and identifying that as our top down, right? We want to essentially size how big these opportunities are going to be, right? And if the size of that opportunity or that technology is much larger than what the market is anticipating, then it becomes very interesting to us. And that's when we want to start investing in it. If we get to the same conclusion as everyone else, there's no inefficiency there, right? And this has happened in the past, several years ago when we were looking at virtual reality, where we came to a total addressable market that was lower than what everyone was anticipating because they were getting caught up in the hype and the promise, but the adoption wasn't there yet. So it was just still too early, and people were overpaying for a lot of those companies. Now, fast forward, now we've actually hit that tipping point. We've seen an increase in adoption. The pandemic has a lot to do with that. People staying home, turning to video games and virtual streaming. That has accelerated the adoption of virtual reality and augmented reality. And we had breakthroughs in AI that have contributed to that. And so now we're finally hitting a point where it's becoming an investable technology. So those points are very important to think about when investing in innovation.
Got that right. You spoke about businesses leading to new business opportunities later on. For example, Android created so many other business opportunities over a period of time. And you also mentioned that some of these technologies have to be ready. They have to be prime time investable technologies, or that's the term that you used. Yes. Can you mention some of them which you think right now are ready, and which are the core focus area when it comes to disruptive innovation?
Yes, absolutely. So on the next slide, the way we kind of center our research is around these 5 innovation platforms. They kind of sit at the top. They're kind of the broad innovation themes that we're investing in. But underneath of them we've identified right now, and this number can change over time as more and more technologies are built on top of these platforms. But right now we're focused on 14 underlying transformational technologies, all of which we think are ready for that primetime investment. So they span from adaptive robotics, which I mentioned, 3D printing, all the way down to gene editing, reusable rockets, all of these, some earlier stages than others. Others starting to finally really, I wouldn't say mature, but further along in their adoption rates. So we're starting to see a lot of that value being created now, but it's still early innings, and so these are still very attractive investment opportunities. But maybe I'll touch on genome sequencing a little more and gene editing. And this kind of gives another example of how we got to the platform, and then we're able to kind of identify some of these technologies being built on top of them. So DNA sequencing essentially allows us to understand, the code of life, right? We have, 38.2 billion lines of code in our DNA, humans. And so DNA sequencing allowed us to really start to understand that code. And as we were able to learn more about how genes impact, various diseases and other things, we learned that we could actually start to edit these genes or mutations in our genome through CRISPR gene editing. This was one of the most successful technologies that we've seen in the last decade that allows us to do this. And one of the founder inventors of this technology, Jennifer Doudna, won a Nobel Prize for this discovery. And we're seeing that we can now edit mutations in our genomes and essentially cure diseases. And this is a totally different approach. We were used to in the healthcare space, identifying a symptom and then just treating those symptoms. But really the underlying disease may not go away or may not be able to be cured. But now with gene editing technology, and there's new technologies being built on top of CRISPR, base editing, pair editing, all these newer technologies that we're very focused on, that could essentially cure these diseases. And, we can completely avoid that. And there's a huge unmet need here. As more and more of these treatments and cures come out, they can impact the populations. And so there's a tremendous amount of value that will accrue to those companies that are developing these technologies and these cure for these companies. And so we've been very focused on that area. And also kind of the other side of that, the diagnostic area. Also, you need very good technology to identify these mutations in your genome and catch those diseases much earlier on. So in cancer, a good example, we've seen a lot of breakthroughs in the early detection of cancer, right? And so rather than waiting for an MRI or a CAT scan where cancer is just visible, right? Visible to doctors, you want to catch cancer when they're very, very early stages. And so through liquid biopsy, which is essentially just a blood test, we can use what's called now long read sequencing to better understand the traces and find the traces of cancer in our blood, which is at a much earlier stage. And so now it's much better. You have a much higher success rate at treating cancer if you catch it in a stage 1 or 2 versus 3 or 4 when it has spread throughout the body. So there's been a lot of breakthroughs in that technology and detecting that and using liquid biopsy. And many of the names that we own in our portfolio, at least in our genomic portfolio, have exposure to that theme. And so this is an area that we've been very, very focused on, and one that one that has underperformed. It was the best performing kind of theme and technology in 2020. In 2021, it was the worst. And there's reasons for that because that we've seen the market really attacking some of these higher cash burn and lower cash balance companies, which tend to be in the genomic space. Meanwhile, the technologies have accelerated in their adoption, and it's been even more attractive to us. And so these companies have been, from a valuation standpoint, become more attractive, and we've actually been building a lot of that exposure because of the breakthroughs, and also how artificial intelligence is playing a very strong role in this. And I think that's what a lot of biotech analysts is missing, because they're not well equipped to really understand the artificial intelligence side, because that's a whole nother study of computer science, right? And they have very advanced degrees in the medical field, PhDs, etc. Our team, because it's very collaborative, not only have domain expertise in the technologies that we're researching, but they also interact with one another. So our genome analysts are constantly interacting with our artificial intelligence analyst. And so they're working together in some cases on some of these stocks, because these worlds are converging simultaneously.
Sure. Thank you, Ren. I want to ask you about how do you value these companies, and what is the investment framework that you carry and you run to identify these companies, and then eventually how do you value them? But before that, I want to understand from you, what is the structure under which the whole research is done? What is the team, and how do you approach this whole disruptive innovation investing?
Yes. So I mentioned briefly earlier, we break our analysts out. First, we hire our analysts that have domain expertise in the underlying technology. So what you'll notice is that our analysts typically don't have financial analysis experience, and they don't come from the finance world. And many believe that that could be a negative, but in fact, we think that's a very strong positive, because these analysts, their role is really to break down and understand these technologies that you see here on the slide. And, having that expertise and coming from these fields, we have, a former founder of a cybersecurity AI company that is, working on the artificial intelligence, area. So he comes from that world. He has that computer science background. He's very well equipped to understand some of these breakthroughs in these technology areas, understand them, look at the cost declines associated with them, forecast the adoption rates, and then get to those total addressable markets, right? So our top-down work is very different than traditional Wall Street, because we start at the technology level and we break down the technologies, and our analysts, can really understand those technologies, and they interact with one another, as I mentioned earlier. So our analysts are conducting all the research, and they are also doing the bottom-up work. And I'll get to the valuation, your valuation question in a moment. But they're working on both that top-down and bottom-up work. But Kathy and our director of research, Brett Winton, is overseeing the analyst team. Both Kathy and Brett have actually worked together going on 15 years now. Kathy was the CIO for global thematic strategies at AllianceBernstein. Underneath of her was a strategic research analyst, Brett Winton, who did a lot of the work on innovation that she was focused on at AllianceBernstein. And he's been with ARC really since the beginning, 2014, and really the primary architect of building out our research ecosystem and open sourcing it, and working with the analysts to really model and train them on how to model, because our approach is much different, again, from traditional Wall Street. So to get into kind of that evaluation approach, we look at it from a 5-year time horizon, right? So most analysts are looking maybe 1 year out, maybe 2 years, but they're very short-term oriented. But because we're looking at these technologies that may take several years to play out, right? So, and there could be, for instance, autonomous driving. There's very little, if any, revenue that has been generated by that technology. However, in 5 years, we think that could be, in the trillions. But it doesn't mean that because there's no revenue now, you shouldn't pay attention to it. So you should be very focused on it, because it could be disrupting a lot of our traditional transportation methods, whether it's trains, just human-led ride hailing. Because we move from to autonomous, that could be very disruptive and lower the cost and really change the way we travel. So we're looking at these technologies over at a minimum 5-year time horizon. And so once we identify a technology that's investable, ready for prime time, we go out and we search for companies that are the key enablers and beneficiaries of these technologies. And we think the value will accrue to a select group of winners, right? There will be a lot of losers in each of these areas. And so we don't take a scattershot approach where, we identify, okay, adaptive robotics is attractive opportunity. Let's invest in every single company that mentions the word robotics, right? There's plenty of products out there that do that, but we think taking an active approach in our management or portfolio management and identifying more of a rifle shot in identifying those select group, maybe it's 3, maybe it's 4 or 5 potential winners, will lead to better performance over time. And so that's how we take that's how we approach selecting securities. Now, when we actually do the valuation, we're basically setting a 5-year expected return on that particular company. And so we can calculate an annualized compound annual growth rate for those companies. And so our minimum hurdle rate of return is 15% annualized over the next 5 years. So we're looking for these stocks to double. And if they don't meet that criteria, that's where we look for other companies, or we may start to sell those companies if they've been held. So we're looking at, well, how big is this technology going to be? How much market share can that company take of that future expectation of that market? And then we can back into what that price target should be for 5 years out. And again, if it meets that hurdle rate of return, then it becomes an attractive opportunity for us to invest in.
Sure.
So valuation is very, very important to us. We don't you may be looking at, a price to earnings ratio or some of these traditional metrics, and you would say, I don't want to invest in ARK's portfolio. The valuations are way too high if I look at earnings. But we believe that that's not the right approach when valuing innovation, because again, a lot of the value and revenue have yet to be realized. And these companies are earlier stage, so they may be sacrificing their profitability in the short term to invest very strategically and aggressively in R&D spend, in capital expenditures, or even making strategic acquisitions that will keep them and keep their competitive advantage over their incumbents. So we're okay with them spending and not being profitable for several years. That will come as the company matures. So it's really looking at kind of the top line growth expectation for these companies, not the bottom line.
Sure. Ren, just taking a cue from the last part of your answer, traditionally, when you value companies in the traditional sense, you pay attention to a lot of cash flows, how companies are growing and what could be a return on equity over a period of time. What are the few parameters that you look at? You mentioned the return that they should double over a period of time. But internally, what are the key matrices that you look at? I'm sure a lot of your portfolio stocks have seen tremendous amount of top line growth. So I think that is one of the criteria, a key important criteria, which differentiates a lot of companies. But what are the other key matrices that you look at when you value these companies?
Yes, that's an excellent question. And for those that want to kind of dive deeper into this area, we actually have open sourced a number of our models. So they're out there for you to download, play with, and we have blogs that kind of explain how we value these companies. So one of the ones that we have outsourced and updated a few times now is our Tesla model. So I'll give you that as kind of an example, right? The way we look at it, there's really two parts of that company. There's the EV business, and then there's the autonomous ride-hailing business that we think, will accrue most of the value for Tesla over the longer term. And that's why we still hold it as a top holding in the portfolio, because that value has yet to be realized, and the market is underestimating the size of that opportunity. So when we look at the EV market, we're seeing, hey, we think that 40 million EVs will be sold by 2026. The market is expecting maybe a fifth of that. So they are expecting that EVs will not have that much growth. But meanwhile, when we're looking at the valuation for Tesla, we're expecting that Tesla is not only taking market share in the EV space, but we are conservative in that best case, we think they will lose 1/3 of their market share, so that other traditional auto manufacturers will come in and compete with Tesla, and that's starting to happen. Meanwhile, the technology side, many of the incumbents are still very far behind Tesla. So Tesla still does have a very superior product when it comes to the battery technology, and allows them to drive the cost down even further, which their competitors cannot do yet. But that's, from a valuation of the EV business, we're looking at, well, that 40 million EVs sold, their market share, this could be an X amount, revenue opportunity, and it's much larger than what everyone is anticipating. So we're able to take that 5-year expectation of the revenue generated, kind of discount that back to present day, and that's how we value kind of, the EV business. On the ride hailing, it's a little harder because there's no revenue yet, but we think that the market for ride hailing, all based on the analysis that we've done and the cost per mile, right, it's going to be about 1/3 cheaper to take an autonomous taxi than it is to personally own your own vehicle. And so with, when you buy a car, you're essentially just buying a pre-bundled, amount of miles, right? And so this will be changing, just like we do with data in our cell phones. We were shifting to kind of pay per use, and with autonomous coming in at 25 cents per mile versus 75 cents if you own your own car. We'll see a lot of adoption here, and that will create an opportunity that's much larger than what people are anticipating. And the margins, because it's really kind of almost like a software as a service, right? This isn't a good with, it's not like a one-time vehicle sale, which has 20% margins. This could be 80% margins and reoccurring revenue. So for instance, Tesla, and this is how we value it, Tesla would be receiving a platform fee for all of their Teslas that are uploaded to the autonomous ride-hailing platform. And that could look like, anywhere for just looking at Apple when they charge for iTunes, that could be anywhere from 20 to 50%. So if you're charging $1 per mile, right, and you're driving 100,000 miles, autonomous miles per year, that could be anywhere from $20,000 to $50,000 per year per Tesla out there on the road that Tesla is keeping at a very high margin because the software developer developed and they're just pushing it out there. And so that is a very large source of revenue. And that's what gets us to kind of our bull case for Tesla, which is, $4,000 currently, our price target 5 years out, because of that opportunity that, again, has yet to be realized, but we think is still the likelihood of them achieving it is much higher now than it was several years ago because of their ability to get more cars on the road and collect that data, which is bettering their autonomous driving platform.
Ren, when we look at these technologies, a lot of them are evolving and gaining in scale. And many of these companies are also, their business models are unfolding. A lot of promises are being met. Some of them are not being met over time. When you look at your investment process, what is the exit process that you follow? When do you, start believing that your hypothesis is now probably getting fully discounted in the market, or maybe it is, not getting proven the way that you want it to be? So what kind of exit process do you exercise?
Yes, and that's another very important question because I mentioned earlier, the other mistake a lot of investors make is they overpay. And so we certainly don't want to be holding a name that we think is overvalued. And so we're very active in our trading. There's kind of two reasons for that. One is because innovation is inherently controversial, and that can cause increased volatility throughout different periods of the market. But if we're very active in our trading, because these underlying technologies have very low correlation to one another, meaning the way what's happening in a DNA sequencing stock isn't impacting what's happening in a 3D printing stock, right? So they're moving in different directions. And so we can actually trade around that volatility and use it to our advantage rather than just taking kind of your buy and hold approach and letting that holding, just sit in the portfolio for 5 years, right, before selling. So we're constantly evaluating the underlying metrics that we use to determine whether we want to invest in that company. So we have a 6-metric scoring system. The first 4 metrics are qualitative. So we're looking at the company, the people, culture, and scoring it. We're looking at their ability to execute kind of on their longer term vision. We're looking at their product and service leadership, right? And we can quantify that in terms of how much market share are they gaining from their incumbents. And then finally, we're looking at their moat or barriers to entry. So their competitive advantage at the technology level and also at the company level, or the business level, I should say. And so if there is a deterioration in any of those scores, that could cause us to reevaluate the stock and potentially sell that. I would say I would put that in, that's typically, it happens. It definitely happens. A good example is Zillow, where they made an announcement that they were shutting down their Zillow offers business. This is a fintech / real estate company. And so they decided to kind of shut down that business. That was a business that we had high hopes for. That caused one of the scores, their competitive advantage, but also their product service leadership to decline, which caused us to exit that position. The most common, I would say, reason for us to exit a position is the 5th metric, which is valuation. So if we enter the position based on the expected 5-year price target and it exceeds our 15% annualized hurdle rate of return, if that stock appreciates over 6 months, a year, 3 years, 5 years, and that expected return from today on drops below that 15% hurdle rate, it's likely that we will start to transition out of that position and move on to a more attractively priced stock. So that tends to happen quite a bit. And then the last group, I would say, based on the market conditions. So what we've experienced the last year is innovation underperforming the broader market. And really, a lot of our stocks have been indiscriminately sold off. And that's put downward pressure on the prices. Meanwhile, the fundamentals are still very strong. And our conviction is either the same or even higher than it was, a year ago. And so what we tend to do in these down markets is consolidate the portfolio into our highest conviction stocks. And so we may sell the bottom 10 names in the portfolio, but that's because of the consolidation and taking advantage of the opportunity that's at hand and setting us up, repositioning the portfolio for us to, and we've done so, we've seen this in the past where because of that consolidation, we've been able to, when the market recovers, we've been able to outperform in those subsequent risk-on periods or those market expansion periods. And that's because of the work that we do in these consolidation periods. Probably the worst thing we could do is just sit there and watch these stocks drop. We like to buy into that weakness. We are kind of short-term contrarians. And that's when we get great buying opportunities. And, over the last year, we've had a lot of opportunities to buy stocks that we really liked, but were too expensive. But that has shifted, and now we're getting a lot of great value out there in the market.
Sure. Then one question about the kind of companies, because we are in the innovation business. When you look at some early adopters like, IBM, created or invented the PC, or Kodak, the digital camera, or you look at the late adopters, Amazon in cloud, or Google probably was the last to the search engine. There are different kind of winners. So what do you think is the core to your philosophy? You look at early adopters or late adopters, and what kind of longevity you are looking at?
Yes. So the key there is not to invest too early, right? So we want to see that the underlying technologies that those companies are working on are hitting that tipping point, right? And so by focusing on the technology, that helps guide us to, what are the right companies that are kind of hitting that the right inflection point. Now, taking the Amazon, the Googles, really the FANG stocks right now, right? You'll notice that we don't have any exposure to those FANG stocks today. And that's by design because, and if you look back, 5 years ago, we did have a decent amount of exposure. But now with, the FANG stocks really making up most of these broad-based indices. I mean, they essentially dominate the NASDAQ index. I think it's close to approaching 40% of that index is the FANG stocks. You have the S&P 500 here in the US. I think it's approaching about 20% of that index. Many investors, I think there's $13 trillion linked to the S&P 500, right? So a lot of investors have exposure to these names that are kind of later stage, right? Their core businesses are later stage in the cycle. And so we don't want to double up on that exposure. So we're looking for the next group of, FANG stocks over the next 5 years. And typically those names are not part of the broader based indices. So investors that are investing in, the S&P 500 or the MSCI world, they don't have exposure to these innovative companies. And that we think is a very big risk. And that's what we're trying to provide to our investors. But there are opportunities even in some of these larger companies that are, their core business may be mature. For instance, Google, they've had a number of breakthroughs in their deep learning, deep mind segment, and alpha folding proteins that we think will be very impactful to the genomic space. And so there were times that we held Google in our genomic portfolio because of that. Just that really one business that we think, very small, no one's paying attention to in Google, but could actually create enough value that would actually drive a doubling in the stock price. So there are some opportunities currently. We're not seeing that as much. We've seen the run up in the FANG stocks. They've been really carrying the market here as the market has looked to kind of them as more defensive names. So we've been steering clear, but I think it can come in any shape or form, right? And so the main point I'll make here, we are agnostic to market cap, sector, industry, because innovation cuts across all geographies and all market caps. So, in electric vehicles, for instance, we think maybe a larger cap name, it may be more successful than some of these recently IPO'd companies that have come to market, like a Rivian, that, they don't have really a product yet. So they're still very far behind. It's going to be much more challenging because they don't have the capital to compete with a Tesla. We think maybe, a traditional auto manufacturer like a Volvo, Volkswagen has a much better chance of competing. So there is, that's how we're kind of looking at the space.
Oh, thanks for that, Ren. One question, Ren. Markets discount everything, before it really happens on the ground. It's a discounting mechanism. Do you think these technologies, which are, I think, still a lot of people are exploring them, understanding them, how far we are away from these technologies becoming really mainstream in the investment world? Maybe they will take some more time to become mainstream in the real life, but in the investment world, these companies will start getting value much ahead of others. So where is that tipping point, 25, 28, or, what are the numbers? Which are the years that you're looking at?
Yes. So, what's very good and interesting is that each of these technologies are in different kind of inflection points, right? And that's good in the sense that it allows us to create a very diversified portfolio, right? So if we are off, a year on our 3D printing forecast, it's not the end of the world because it could be that EVs, actually happen sooner than we were expecting, right? And so it can balance out over time. What I would say is if I'm looking at these 14 technologies, we've seen a lot of breakthroughs in the genomic space that I don't think the market is really talking about when it comes to multi-cancer screening, gene editing, and long read sequencing. And so that is an area that we expect to, start to attract media attention over the next year, 2 years. EVs, I think, is you go back 2 or 3 years, no one believed it would actually gain traction. Now we're starting to see that everyone's talking about that technology. And again, we've been there well before, everyone started talking about it. AI was one we were talking about back in both AI and blockchain were ones we were talking about back in 2015. AI became kind of a big theme in the late teens, 2018, 2019. That's gone a little quiet, but now that's coming back because of the breakthroughs in AI and the cost decline. So, people, they get caught up in the hype, they forget about it, because sometimes it's too long into the future. It's 2-3 years away. Meanwhile, there's so much progress happening, and blockchain is another good example. There's a huge bull market in 2017. Everyone was talking about, our grandparents were asking us about Bitcoin and how to invest. But then everyone kind of forgot about it. And now there's been so many breakthroughs in the technology. Now that's hitting another inflection point where, there is a very attractive investment opportunity. So these things come in cycles. And so, you can't just, try to catch them when there's hype. You have to continue to do the research over many years and identify those opportunities over time. Because again, a lot of these technologies are even starting to converge. And so they're impacting one another and helping them grow even faster.
Sure. Ren, what I understand is your portfolio is roughly anti-inflationary, so to speak. Correct me if I'm wrong. And let's say if inflation runs wild and we see another inflationary scenario, how do you tackle that? Is that baked into your hypothesis, or your base hypothesis remains that inflation will not be a problem?
So maybe just to add to that point, I would say some aspects of the portfolio can benefit from increased inflation. Now, I think overall, I would say kind of the macroeconomic environment and these fears of inflation have been impacting most directly growth and innovation. And that's the primary reason that we've seen, innovation underperforming the broader based indices. But at the same time, we have a much different view on how this inflation issue will play out. Here in the U.S., the central bank or the Fed has been talking about that this inflation could be much longer than originally anticipated. However, we're looking. Kathy, by training, is an economist, and we've tapped into our open research ecosystem to speak to some of the leading economists around the world, and we're starting to see data that suggests the opposite. And in fact, we could be turning into a deflationary environment. And there's good deflation, there's bad deflation. The good deflation is really being driven by technology-enabled platforms like these. So the fact that these technologies are making our products and services cheaper and more affordable to the broader populations will actually spawn more economic growth and expansion, right? The fact that EVs are dropping dramatically, even DNA sequencing cost has dropped. So it's likely that almost everyone will be able to get their genome sequenced very soon in the next few years, at their annual physical, and they'll be able to kind of track that mutations in their genome, because the cost to sequence, will only be $100, and it really costs nothing. So that's what we're kind of seeing, how good deflation will play out. Now, the bad deflation, and we think this could play out, and maybe in the 3 to 6 month time horizon, but we're starting to get signs that inventory levels are starting to build up in retail sales and also in the auto space. So this is signaling to us that a lot of people did a lot of buying ahead of the holiday season. And a lot of those inventories have kind of been built up into their garages or in their homes. And we've seen that the savings rate has dropped. And so it's likely that they don't have enough disposable income to really go out there and spend over the next year. Confidence has dropped, consumer confidence. And with that savings rate dropping, there's less disposable income. And so those inventories could continue to pile up. And then we could see that, companies want to unload that inventory and start dropping prices. And so that's where you see the deflationary aspect coming into play. And so that would benefit growth because if people are anticipating inflation rising, they are going to get more defensive. They're going to go into cyclical, value-oriented companies, which obviously we don't own because we're high growth, innovation focused. Meanwhile, that could also be creating a very large risk for them because they're investing in industries and sectors that are increasingly becoming more vulnerable to disruption. So when you think about, a lot of assets have flowed into energy-based fossil fuels, and if we're right on EVs, that could be very disruptive. A lot of assets flowing into the financial services, and with fintech and blockchain disrupting traditional banking services, that could be very detrimental to these areas. And then also autonomous driving, transforming the transportational, regional airlines, taxis. These are companies, that railway assets that could be under distress over the next several years. And investors are piling into these industries because they think it's defensive, yet it could actually be very risky. So we think having just some exposure to innovation, even if inflation continues, example of how to counter that, if oil, which is the only commodity really that has still stayed high, we've seen a pullback in a lot of the other commodities, which suggests that inflation could be turning the corner, but oil remains high. But that also strengthens the case to shift to EVs. And we're starting to see that in the data. So these technologies are really solving those problems and providing exposure, providing lower cost options to consumers.
Absolutely. Ren, this is going to be a very eventful year. Maybe, Fed has already said it is going to end its, stimulus program where it was doing the quantitative easing by March, and markets are factoring in about 3 to 4 interest rate hikes. So how do you prepare for 2022? Any specific strategy, or do you think your horizon continues to remain long-term?
Yes, our horizon remains long-term. We're looking at these technologies 5 to 10 years out. We've not made any changes to our philosophy, the investment process. We stay convicted in our research process and continuing to better understand these technologies, find the enablers and the beneficiaries of these technologies, and look, find the most attractively priced and most inefficiently priced companies out there. And so, I think there was a fear that there's not enough innovative companies out there. Meanwhile, we've seen our universe double in the last year as we've seen a lot more companies going public. And once they become public, they're becoming part of our universe. So there's an increasing amount of opportunities out there. And through our research process, we've been able to identify who we think will be those winners. And we continue to be very active in these down markets. We don't panic, right? We don't sit there and do nothing. We take advantage. We're actually, if Kathy's very excited about this period right now because we've been able to buy into this weakness. And as long as you're a long-term holder, this is a very attractive opportunity to be investing, right? We think from a valuation standpoint, this is one of the most attractive entry points that we've seen historically in the last 7 years that we've been managing, our innovation strategies. The last highest was back in December of 2018 when the market had crashed. It was right before Christmas. It hit a low, and now we're seeing we've approached those levels now, and so that's again creating a very attractive opportunity for us. Again, you have to be a long-term investor. This is not something, we're not investing for the next 6 months or the next year. In fact, it's much harder to forecast and predict what's going to happen in the markets in the next 6 months. We think it's a lot easier to figure out what these technologies will look like and how big they will be in 5 years from today. And so people get scared about forecasting what the world will look like in 5 years or even 10 years. We love to do that, and we think it's actually a lot easier to do.
Oh, and one last question to you. As investors, when we look at investing in innovation, you've been pioneer in this field. As investors, how should we look at this investing landscape? Should we look at this from a 5-year point of view, from a 10-year opportunity point of view, and what kind of volatility can we expect in this kind of a theme?
Yes, I would definitely take at least a 5-year time horizon. We've done some work to just kind of look at our historical performance and the various entry points that our investors get in. So we've seen that even over a 3-year period, that we've been able to outperform our benchmark, which is essentially a 15% annualized return. It's really an absolute return benchmark. But investors that have gotten in at any point, if they've stayed in for over 3 years, they've been able to achieve that return. Now that's, historical performance is not indicative of future success. Want to add that disclaimer, but we're seeing that as you extend your time horizon, the chances of outperforming that increase. And that's because it aligns with our investment philosophy.
Right. Thank you, Ren. I think that was very insightful, our conversation with you, and a lot of doubts answered, a lot of things learned. Thanks a lot for your time, and we'll probably have you once again, next time when we discuss innovation. So thanks a lot for coming together.
No, thank you very much for having me, and I do look forward to seeing you again soon. And I would like to thank everyone for joining today as well.
Yeah. On behalf of Nico AM as well as the ARC team in the US, thank you so much, Kapoor and the DSP team. We'll converge again and provide some numbers to the ARC team as well. Thank you so much.
Thank you. Thank you, everybody, for joining in. Thanks. We'll end.
Thank you. Have a great day ahead. Thank you. And Ren too as well.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.